Welcome, you curious mind, to the deep dive. Today, we're embarking on a fascinating exploration of some seriously important ideas.
We are indeed.
We've got Thomas Piketty's huge work, Capital in the 21st Century, as our main source material.
A really significant book.
Yeah, absolutely. But look, this isn't about getting bogged down in dense economic theory.
No, definitely not.
Our mission here is to pull out the core insights, the stuff that really matters, and translate it into, well, actionable knowledge. Things that can help you understand wealth, inequality, the world around us, really.
Kind of a shortcut to the big ideas.
Exactly. Think of it like that. Your shortcut to grasping some of the fundamental forces shaping our economies.
And Piketty, he dives deep, doesn't he? Centuries of economic history, loads of data, looking for these long-term trends.
Right.
So what we want to do is pull out the most relevant patterns and, maybe more importantly, talk about what these might actually mean for you, for us, in our lives today.
Okay, so let's start right at the beginning. The basics. Piketty lays out these two fundamental concepts, income and capital.
Yeah. Income is, the flow, your salary, what comes in regularly.
And capital.
That's the stock, the stuff you own, assets, your house, maybe investments, stocks, bonds, that kind of thing.
And Piketty really focuses on the relationship between these two, right? The capital-income ratio.
Exactly. He uses the Greek letter beta for it. It's basically the total wealth, the total capital in a society compared to the total income that society generates in, say, a year.
So is a country sitting on a huge pile of assets relative to its annual earnings? Or is it more about the flow, the income?
That's the core question he tracks over time.
Okay. Now, there's a quote from the book that really, well, it jumped out at me. The price system knows neither limits nor morality. What's the message there for us trying to navigate our own, financial lives?
It's a powerful statement. I think the idea is that markets just on their own don't automatically have fairness or sustainability built in.
Yeah.
Think about housing prices in big cities. They can shoot up way beyond what people who work there can afford just because demand is high. The market doesn't really care about affordability per se.
Or oil prices.
Exactly.
Yeah.
Oil prices fluctuate based on supply, demand, geopolitics, huge impacts on everyone, but the price mechanism itself isn't making an ethical judgment.
So Piketty's warning is that if we just let these market forces run completely free,
We could end up with really significant imbalances, economic, social, even political ones.
yeah.
It actually echoes older concerns, like Ricardo worrying about scarce land, making landowners incredibly powerful and rich.
Okay, so Ricardo was focused on land scarcity, and then Marx came along and shifted the focus.
Yeah, Marx looked at industrial capital, factories, machines, that sort of thing. He saw it differently.
How so?
He had this idea of the principle of infinite accumulation. Basically, the capital, unlike land maybe, could just keep concentrating in fewer and fewer hands, almost without limit.
And he predicted some pretty dramatic consequences from that.
Oh, definitely. He saw two main possibilities, really. Either the returns on all the concentrated capital would eventually fall so low that the capitalists would fight among themselves.
Okay.
Or the other path, capital's share of the pie, would just keep growing indefinitely until the workers, who weren't getting much, would revolt.
Stark choices. Not exactly optimistic.
Not at all.
But then later on, we get Kuznets, right, with a more hopeful view, suggesting inequality might actually decrease as economies develop.
Yes, Simon Kuznets, mid-20th century. His idea was based on some of the first really good, large-scale economic data becoming available,
Data like,
specifically income tax returns. The U.S. started collecting federal income tax data in 1913, and this gave economists a way to actually measure income distribution across the whole population for the first time, instead of just theorizing.
and what did that early data seem to show him?
His initial analysis suggested a pattern, the famous Kuznets curve. Inequality might rise during early industrialization, but then as the economy matured, it would start to fall.
Interesting. So before we had widespread income tax data, how did people even try to study wealth inequality historically? It seems like it would be incredibly difficult.
It was. But researchers got quite clever. They used things like estate tax returns, the taxes paid on inheritances.
So looking at what people left behind when they died.
Exactly. People like Lampman in the U.S. and Atkinson and Harrison in Britain really pioneered using that kind of data. And sometimes those records go back surprisingly far.
How far?
Well, in France, they've managed to compile individual estate tax records going all the way back to the French Revolution.
Wow. That's incredible.
It is. It lets them track wealth concentration over centuries, see how big fortunes were passed down, and even measure the impact of huge events like World War I on who owned what.
Okay, so putting it together, Piketty talks about these forces. Some push towards more inequality, he calls that divergence. Others push towards less inequality, convergence. What's the big takeaway from looking at all this history? What should we be thinking about?
The main point, I think, is that while convergence can happen, inequality can decrease. Piketty argues the underlying tendency in capitalism, left to its own devices, is often towards divergence, towards increasing inequality.
And that's particularly relevant now.
Yes, because he suggests that with slower economic growth and slower population growth, which is projected for many parts of the world, those forces of divergence could become even stronger.
Why is that?
Well, think about it. If the overall pie isn't growing very fast and there aren't waves of new people creating new wealth, then the wealth that already exists becomes much more important. Inherited wealth, accumulated capital, it potentially gains influence.
Making it harder for those without capital to catch up.
Potentially, yes.
Yeah.
It raises concerns about social mobility and the future concentration of wealth.
Now, Piketty singles out the United States as potentially being a bit different historically. Why? Does that mean the U.S. experience isn't relevant elsewhere?
Well, the U.S. in the 19th century was unusual. It had massive demographic growth, immigration, westward expansion.
Right.
This meant that creating new wealth, building things, maybe mattered more relative to inheriting old wealth compared to, say, Europe at the time, which had more stable populations. Inherited wealth was less dominant.
So the U.S. path was unique for a while.
For a while, yes. But Piketty's point is that as global growth slows down, the historical European experience, maybe France being a good example with its long history, might actually become more relevant for understanding future global trends, including in the U.S.
So the underlying forces are still at play.
He argues they become increasingly important everywhere as growth conditions change.
It's also fascinating that 19th century France, even after its revolution emphasizing equal rights, apparently had wealth concentration levels similar to aristocratic Britain. What does that tell us today when we hear arguments that just ensuring equal opportunity in the market is enough?
It's a really crucial historical lesson, I think. It shows that formal legal equality, saying everyone has the same rights to participate in the market, doesn't automatically translate into equal outcomes.
The starting line matters.
Hugely. Despite the ideals of the French Revolution, wealth remained incredibly concentrated. So it suggests we need to be critical of the idea that just having free markets will sort out all inequality issues. Historical advantages, the existing distribution of wealth, these things have inertia.
So for us as listeners, it means we need to look beyond just the rules of the game and see who actually has the playing pieces.
Something like that, yes. Understanding the existing landscape of wealth is key, not just assuming a level playing field.
Let's shift gears slightly to the capital-labor split, how the economic pie gets divided. What's the fundamental tension there?
It's basically about how much the total value created in an economy goes to the owners of capital, that's profits, rent, interest, dividends, versus how much goes to those who provide labor, wages, and salaries.
And there's always a push and pull there.
Always. You obviously need returns to capital to encourage investment and growth, but the big question is whether the market naturally finds the right or fair balance.
And historically, has that balance been stable?
Not really. Piketty shows it's varied quite a lot over the 20th century, influenced by things like the World Wars, the Great Depression, government policies, deregulation. By understanding this dynamic, you can better analyze, who's benefiting most from economic growth at any given time.
Okay. Now, what about the idea that, say, France or the U.S. is mostly owned by foreigners, like Chinese investors or California pension funds owning everything? Is there truth to that?
That's a common perception, isn't it? But Piketty looks at the data, the net foreign asset positions, and he finds that for most wealthy countries, it's roughly balanced. The amount of domestic assets owned by foreigners is often comparable to the amount of foreign assets owned by that country's own citizens.
So the wealth isn't necessarily flowing out massively?
Not in the way people sometimes imagine. He argues that the real issue isn't so much international ownership imbalances, but the huge inequality in how capital is owned within each country.
So it's more about domestic inequality than foreigners owning the place.
Primarily, yes. The tensions over wealth are mostly internal, between citizens of the same country.
Got it. Let's just quickly nail down the definition again. When Piketty says capital, what exactly is included and what's not included?
Right, so he's talking about non-human assets,
Hmm.
things that can be owned and exchanged on a market,
Like,
like real estate land, buildings, financial assets, stocks, bonds, and professional capital, think machinery, equipment, patents, that sort of thing.
and what's explicitly excluded?
Crucially, he excludes human capital. So your skills, your education, your ability to work, that's obviously vital, but it's not part of his definition of capital in this context. He's focused on the dynamics of these ownable, tradable assets.
Okay. He also mentions historical rates of return, especially on land back in the day. What was typical and why does that old benchmark matter?
Yeah, he finds that in, say, the 19th century, before widespread industrialization, a typical annual rate of return on agricultural land was pretty stable, around 4% or 5%.
And people kind of knew this.
Apparently so. It was common enough knowledge that it even pops up in literature from the time Jane Austen, Balzac. Characters' wealth might be described by how many years of rent their land generated, often around 20 years' worth, which implies that 5% return.
So it gives us a historical baseline for returns on a major asset class.
Exactly. It provides context for the returns we see today on different, maybe more complex assets. A reminder that the basic idea of getting a return on invested capital isn't new.
Okay, let's zoom out to the global picture around 2012. Piketty gives a snapshot. What does it tell us about the sheer scale of the global economy and the potential for inequality?
Right. Around 2012, global population was about 7 billion. Total world output was roughly 70 trillion euros.
So if you divided that equally,
It would come out to about 10,000 euros per person per year, or maybe 760 euros a month.
which of course is nowhere near the reality for most people.
Precisely. It just highlights the enormous size of the global economy and simultaneously the massive disparities in how that income is actually distributed.
He also makes a distinction between exchange rates and purchasing power parity, PPP. Why is that important for comparing living standards?
It's super important. Exchange rates just tell you how many dollars buy a euro or whatever, but PPP tries to account for what that money can actually buy in different countries.
Because prices vary.
Exactly. A euro might buy you a lot more coffee or bread in one country than another. So if you want to compare real living standards, you need to use PPP adjustments, which Piketty does. It gives a much more accurate picture of global inequality.
Going back even further, before World War I, what did global investment look like? Were there big imbalances then?
Oh yes. Before 1914, there were significant international imbalances. European powers, especially Britain, France, Germany, owned a very large share of the domestic and industrial capital in places like Asia and Africa.
So a lot of colonial-era investment.
Essentially, yes. They were drawing significant income from assets held abroad. That historical context is pretty crucial for understanding the origins of some of the global wealth gaps we still see today.
Let's talk about long-run economic growth. What are the big trends Piketty identifies, and what are the implications for our future?
Looking back since the Industrial Revolution, say from 1700 to 2012, Piketty calculates the average global growth rate at about 1.6% per year.
That seems surprisingly low.
It does, doesn't it? And that 1.6% is roughly split half and half between population growth, more people, and per capita output growth, each person producing more.
In looking forward,
He anticipates a big demographic shift in the later 21st century. Population growth is expected to slow dramatically or even reverse in many parts of the world, with Africa being the main region still seeing significant growth.
and if growth slows down, especially population growth,
Then we're back to that earlier point. Slower growth tends to increase the relative importance of capital accumulated in the past. Inherited wealth becomes more significant. We can see societies structurally looking a bit more like 19th century Europe, dominated by wealth passed down through generations.
that's a striking thought. Okay, so overall purchasing power has gone up, but you mentioned relative prices changing. Can you give some examples? How has the cost of living changed in composition?
Sure. So while on average we're much richer, what our money buys has shifted. Piketty notes things like basic foods, maybe like carrots. Their price might have roughly kept pace with average income.
Okay.
But manufactured goods, things made in factories, have often become relatively cheaper because of technology. Transported goods, too.
And services.
Services, especially those needing skilled labor, have generally become relatively more expensive compared to goods. Think healthcare, education, personal services.
But our living standards in areas like health and education have improved massively, even if they cost more.
Absolutely. Access to quality healthcare and education has transformed lives, even if GDP figures might just capture, say, government spending on them, the actual value is immense.
He also contrasts the growth paths of Europe and North America. What's the key difference there?
North America, particularly the US and Canada, has had a generally more stable trajectory of per capita output growth over the long run. Western Europe's path was much more volatile, heavily impacted by the devastation of the two world wars, followed by that rapid catch-up growth period, the Trente Glorieuses, after WWII.
Those different histories probably shape current attitudes and policies too.
Very likely, yes.
Another interesting point was about monetary stability before the 20th century. Money held its value better.
Much better, generally. In the 18th and 19th centuries, there wasn't the kind of persistent inflation we saw in the 20th century.
And this had real-world effects, even in literature.
Yeah, it meant that when novelists like Austen or Balzac mentioned specific sums of money, someone's income or dowry, their readers had a very clear, stable understanding of what that amount represented in terms of purchasing power and social status.
Unlike today, where mentioning a specific salary from, say, 1980 sounds completely different.
Exactly. 20th century inflation kind of destroyed those stable monetary benchmarks, which might be why modern novels are often less specific about exact figures when describing wealth.
Let's loop back to that capital income ratio. You mentioned Britain and France had similar long-term paths.
Remarkably similar, yes. Both showed relative stability in the ratio through the 18th and 19th centuries, then a really sharp drop after World War I due to physical destruction, inflation, debt.
And then?
A gradual climb back up, so that by around 2010, the ratio in both countries was roughly back to where it was before the shocks of the early 20th century.
It shows how resilient that underlying structure of capital can be, despite massive disruptions.
It does, and also how impactful those historical shocks were in temporarily reducing the weight of capital.
Public debt comes up a lot, too, often linked to wars.
Very often, yes.
Yeah.
Britain famously accumulated huge debts fighting Napoleon. France also had periods of very high debt. Interestingly, Piketty points out that in the run-up to WWI, French public debt relative to national income was actually higher than Britain's. Yes. And income from government bonds was a major source of wealth for the French upper classes back then. It reminds us that high public debt isn't new, and it shapes wealth distribution.
And more recently, France shifted from more public ownership towards private wealth.
Yes, after a period from roughly 1950 to 1980, with significant state ownership in parts of the economy, France saw a strong rise in the value of private wealth relative to national income starting in the 1980s. Public wealth didn't keep pace, partly due to privatization.
Which mirrors global trends.
Exactly. Privatization and deregulation were happening in many countries around that time. It shows how policy choices directly impact the balance between public and private capital.
So, just to reiterate, the wars and crises between 1914 and 1945 were hugely destructive for private wealth.
Massively. Physical destruction, requisitioning, high taxes, and sometimes runaway inflation essentially wiped out large chunks of private fortunes, especially those held in bonds or cash. Savers were often hit very hard.
Okay. We mentioned the U.S. being different regarding inheritance. What about foreign capital? Was its role different in the U.S. compared to Europe?
Yes. Historically, the U.S. hasn't been a major net owner of foreign capital in the way European colonial powers were. It started as a destination for foreign investment. So its wealth dynamics have been driven more by internal factors compared to, say, Britain or France with their vast empires.
And Piketty brings up the incredibly difficult issue of slavery as capital in the U.S. South.
Yes, he emphasizes that the monetary value assigned to enslaved people in the American South before the Civil War represented an enormous share of total capital, in some areas exceeding the value of farmland.
It's a brutal illustration of what can be defined and treated as capital.
Absolutely. It underscores that the accumulation of capital isn't just some abstract economic process. It's deeply tied to power structures, exploitation, and profound historical injustices.
Okay, let's get to what Piketty calls a fundamental law of capitalism. Imbandas SSG. Can you break that down for us? What does it mean practically?
Sure. It looks simple, but it's really important. Beta is that capital income ratio we talked about, total wealth relative to annual income. S is the savings rate, what percentage of income a society saves each year. And G is the growth rate of the economy.
So beta SSG.
Right. In the long run, the ratio of capital to income tends towards the savings rate divided by the growth rate.
What does that imply?
It implies that if you have a high savings rate, S is high, and or a low growth rate, G is low, you'll end up with a very high capital income ratio. Lots of accumulated wealth relative to annual income.
So low growth pushes up the importance of existing capital.
Exactly. Particularly low demographic growth. This helps explain structurally why places like Europe and Japan, with lower growth than the U.S. historically, tend to have higher capital income ratios. It means existing wealth, and by extension inheritance, looms larger.
And this applies regardless of why people save.
Yes, the law itself is structural, based on the accounting relationship between saving growth and capital accumulation.
And since the 1970s, we've seen this comeback of private capital. What's driving it?
It's largely that combination. Relatively high savings rates combined with slower economic and population growth compared to the mid-20th century boom years. This allows existing capital to accumulate faster than the economy grows overall.
Leading back towards patrimonial capitalism.
That's Piketty's term, yes. A situation where inherited wealth plays a more central role again.
So slower growth in Europe and Japan is a big factor in their higher capital ratios compared to the U.S.
A very significant factor, yes. Similar savings rates, but lower growth, especially population growth, leads mathematically to a higher equilibrium capital income ratio. For people living there, it suggests wealth dynamics might feel different, perhaps more influenced by inheritance.
And you mentioned privatization and rising asset prices add fuel to this fire.
They do. Selling off public assets adds to the private capital stock. And sustained increases in real estate or stock market values relative to incomes also push up that capital income ratio.
Piketty mentions Tobin's Q in this context. Remind us what that is.
Tobin's Q compares the stock market valuation of companies to the replacement cost or book value of their actual assets, factories, equipment, etc.
And it's been going up.
Generally, yes, since the 70s, 80s in many rich countries. This suggests markets have been placing a higher value on corporate assets relative to their tangible worth, which also contributes to the measured increase in capital wealth.
And crucially, this rise in national capital is mostly domestic capital growing, right? Not just foreign money pouring in.
That's a key point Piketty makes. While there are international flows, the bulk of the increase in the capital stock of rich countries since, say, 1970 reflects the growth of wealth owned by their own citizens. It reinforces that inequality is primarily a domestic distribution issue.
Okay, now the rate of return on capital R, is everyone getting the same return?
Absolutely not. That R is an average, an abstraction. In reality, returns vary hugely.
Depending on what?
Depending on the type of asset, risky stocks might offer higher potential returns than safer bonds or a savings account. And importantly, it often depends on the size of the fortune.
Wealthier people get better returns.
There's evidence suggesting that yes, larger investors might have access to better advice, lower fees as a percentage, and different types of investments like private equity or hedge funds that aren't available to smaller investors. This difference in returns can itself increase inequality.
So the average return hides a lot of variation. Looking at the 21st century, what's the rough breakdown of the capital-labor split now, like in France?
Piketty indicates that in the early 21st century, in a country like France, capital income profits, rent, dividends, etc., typically makes up around 30% of national income.
And the rest is labor income.
Yes, the remaining 70% goes to labor in the form of wages and salaries. The average rate of return is then calculated by dividing that total capital income, the 30%, by the total capital stock, that ratio times national income.
What determines that average rate of return, fundamentally?
Piketty points to two main things: technology, how productively can capital actually be used, and the sheer abundance of capital.
Abundance lowers the return.
Generally, yes. If there's a huge amount of capital looking for investment opportunities, but the technology isn't there to use it all super productively, the return you get on each unit of capital tends to fall. It's like supply and demand for capital itself.
He used that thought experiment, a society where capital has no productive use. What was the point there?
It was to illustrate the theoretical limit. If capital had absolutely zero productive use, its rate of return would be zero. R ups are zero. All national income would go to labor. Capital might still exist as a store of value, like gold hoarded under a bed, leading to a high capital income ratio, but it wouldn't generate ongoing income. It helps clarify the link between productivity and returns.
Let's touch on marginal productivity of capital. What's the basic idea?
It's the idea of how much extra output you get. By adding one more unit of capital, one more machine, one more euro invested, standard economic theory suggests that in a perfectly competitive market, the rate of return on capital R should equal this marginal product.
But markets aren't always perfectly competitive.
Exactly. If a company has monopoly power, or monopsony power being the main buyer of something, it might be able to capture returns that are higher than the actual marginal productivity of its capital.
There have been historical debates about whether a capital's share of income is stable or tends to rise. Where does Piketty land on this?
He shows that it's definitely not stable. While some economists argued for stability and Marxists predicted a relentless rise in capital share, the historical data reveals significant fluctuations. Big events and policy changes have clearly shifted the balance back and forth over time.
He mentions the elasticity of substitution between capital and labor. Sounds technical, but what's the gist and why is it important?
Okay, the basic idea is how easily can you replace workers with machines, or capital more broadly? If that elasticity is high, specifically greater than 1, as some estimates for the 21st century suggest, it means that even if adding more capital makes the return on each individual unit of capital go down slightly, the total share of national income going to capital owners can still increase because capital is becoming so much more abundant relative to labor.
So, more automation could lead to capital getting a bigger slice of the pie, even if returns per machine fall a bit.
That's the potential implication, yes. It could mean a long-term shift in the balance of power towards capital owners.
So, looking back at the 20th century, the big reduction in inequality wasn't just natural progress.
Piketty argues strongly against that interpretation, the one Kuznets initially proposed. He says the evidence shows it was primarily the result of the massive shocks, the world wars, the depression, and the political choices made afterwards. Progressive taxes, social programs, regulations.
And the fact that inequality started rising again from the 70s, 80s supports that view.
Precisely. It suggests that institutions and political choices are crucial drivers of inequality levels, not just some automatic economic law.
Which brings us back to inheritance. The common narrative is that modern growth favors talent over inherited wealth. Does Piketty buy that?
He challenges it significantly. He argues that the historical record and the underlying dynamics, especially RG, suggest that inherited wealth can become extremely important again, particularly in a low-growth environment.
He uses that example from Balzac's Père Goriot, Vautrin's advice to Rastignac.
Yes, it's a fantastic literary illustration. Vautrin basically tells the ambitious young Rastignac, forget trying to make it through law or medicine. Marry a rich heiress. That's the only sure path to wealth and status.
A pretty cynical take on 19th century Paris.
Extremely cynical. But Piketty argues it reflected a certain reality of that era, where significant inherited capital was almost a prerequisite for a comfortable upper-class life. The detail about old Goriot making his first fortune during the Revolution by trading essential goods just adds another layer about how fortunes are made and persist.
Okay, shifting to labor income. Even if average wages rise, the distribution can be very unequal, right?
Absolutely. An average wage can hide huge differences. You can have stagnant wages for many and skyrocketing pay for a few at the top. Understanding the distribution and the forces shaping it is critical for seeing the real social landscape.
And when you compare labor income inequality to capital ownership inequality,
The difference is stark. While wage inequality is a major issue, the concentration of capital ownership is far, far more extreme.
what are some typical numbers?
Piketty cites figures like the bottom 50% of the population, often owning less than 5% of total wealth. The top 10% might own 60, 70% or even more in some places. And within that top 10%, the top 1% holds a huge chunk, maybe 25, 35%. The wealth pyramid is incredibly steep.
France saw a big drop in the top 1% income share after the Belle Epoque. What caused that fall of the rentier?
It was primarily the collapse in capital income for the wealthiest. Those shocks we discussed, wars destroying assets, inflation eroding bond values, new policies like rent control, nationalizations, higher taxes on capital and inheritance, all combined to drastically reduce the income flowing from large fortunes.
And the type of income at the top has changed too.
Yes. Back then, a large portion of the top 1%, or even 5%, derived most of their income from owning capital. Today, while capital income is dominant for the super rich, say the top 0.1%, for many others in the top 1%, high salaries income from labor play a much bigger role than they did a century ago.
What about the theory of marginal productivity for wages? How does that explain wage gaps?
Well, the theory suggests wages are, or should be, determined by a worker's contribution to output their marginal product. It emphasizes supply and demand for different skills. So people with rare, highly demanded skills shaped by education and technology command higher wages.
So if we follow that logic, what's the best way to reduce wage inequality?
Piketty suggests the most powerful lever consistent with this theory is investing broadly in high-quality education and skills training. Making good education accessible to everyone should, in theory, increase the supply of skilled workers, boost wages at the lower and middle end, and reduce the premium paid to those at the very top.
He mentions Scandinavia.
Yes, suggesting their relatively more egalitarian education systems might contribute to their lower wage inequality compared to, say, the U.S., though financing and access remain huge challenges everywhere.
What about minimum wages? How do France and the U.S. compare?
He shows that France's minimum wage, adjusted for purchasing power, ended up significantly higher than the U.S. federal minimum wage by the early 2010s. The U.S. minimum wage, in real terms, actually peaked way back in 1969 and has eroded substantially since then.
There was that brief, odd mention of rising top incomes in Nazi Germany between the wars.
Yes, a disturbing finding linked to industrial profits booming under rearmament and the regime deliberately reinforcing income hierarchies. A reminder that politics can directly manipulate income distribution in extreme ways.
And what about emerging economies like India and China? Is inequality rising there too?
The data is harder to get and less reliable, but Piketty concludes that the available evidence strongly points towards rapidly rising income inequality in these countries as well, with the top earners capturing a growing share of the benefits of growth.
It seems really hard to judge the marginal productivity of a top CEO. How can anyone really know their precise contribution?
It's practically impossible, right?
Yeah.
A huge company's success depends on thousands of employees, market conditions, luck. Isolating the unique, measurable contribution of one person at the top is incredibly difficult, if not meaningless in many cases.
So if it's not purely productivity driving massive CEO pay, what else is involved?
Piketty leans towards explanations involving social norms, the power dynamics on corporate boards, the ability of executives to influence their own pay, especially when top tax rates are low. It's less about objective value add and more about bargaining and perceived status.
Okay, so wealth concentration fell in the mid-20th century, but is rising again. We now have this patrimonial middle class.
Yes, that's a key change. While the very top is still extremely wealthy, there's now a larger group below them, maybe the next 40% or so, who own a significant chunk of wealth, housing, pensions. They own much more than the bottom 50%, but haven't reached the concentration levels of the old elite. But the overall trend since the 80s is towards reconcentration at the top.
And this brings us back to REG. Remind us why that inequality is so fundamental.
Because if the rate of return on capital R is consistently higher than the economy's growth rate, wealth that already exists grows faster than output and wages. Over time, this automatically leads to wealth becoming more concentrated, and inherited wealth becomes increasingly dominant compared to wealth built up from labor income within a generation.
It's a powerful engine for divergence.
A very powerful one. The larger the gap between R and G, the faster inequality tends to rise, all else being equal.
How did progressive taxes in the mid-20th century push back against this?
By taxing high incomes and large accumulations of capital, especially inherited wealth, at significantly higher rates, they effectively reduced the net rate of return for the wealthiest. This slowed down the snowball effect of wealth accumulation and helped deconcentrate fortunes.
And the recent trend is less progressive taxation.
Yes, often driven by arguments about tax competition between countries. Lowering top rates, especially on capital income, weakens that counteracting force against the RG dynamic.
What about estate taxes specifically? How do they impact things?
High progressive estate taxes make it much harder to pass down enormous fortunes intact across generations. They act as a reset button, to some extent, potentially increasing social mobility. Piketty notes rates were much higher in many countries after WWII than in the 19th century, though there's been erosion there too recently.
Piketty's analysis of the wealth of the dead versus the wealth of the living was fascinating. What did it suggest about why people save?
It suggested that the traditional life cycle theory, saving mainly for your own retirement, doesn't fully explain behavior, at least historically in France. The fact that the dead were often wealthier than the living implies a strong motive to pass wealth on to heirs. Inheritance seems to be a central driver of accumulation, not just an afterthought.
But the wars caused a temporary rejuvenation where the dead were poorer.
Yes, the shocks of 1914-1945 temporarily disrupted this pattern. Wealth was destroyed, inflation hit savings, so the wealth people managed to accumulate by the time they died fell below the average wealth of the living for a period. It shows how fragile accumulated wealth can be in crises.
But since the 70s, inheritance is back on the rise.
Dramatically so, according to his data for France. Inherited wealth as a share of total private capital fell to maybe 40% in the 1970s, but climbed back to around two-thirds by 2010 and projected to keep rising. A clear return towards a patrimonial society.
Which brings us back to Balzac and Austen. Their novels weren't just fiction, but reflections of an economic reality.
Very much so. They depicted societies where inheriting substantial wealth, maybe 30 times the average annual income, as Piketty calculates, was often essential for maintaining a certain social standing without having to work. The specific figures mentioned in the books align surprisingly well with the historical economic data. They show us what RG looks like in practice.
People sometimes defend high CEO pay today, using a kind of meritocracy argument. It rewards talent and stops wealth being only about inheritance. What's Piketty's critique?
He's skeptical. He warns against what he calls meritocratic extremism, using the idea of merit to justify potentially exorbitant inequalities, both in wages and in inherited wealth, without necessarily having strong evidence that the wage gaps reflect real productivity differences. He worries it could lead to the worst of both worlds: high inherited inequality and high, potentially unjustified, wage inequality.
And even for people not inheriting vast fortunes, the flow of inheritance still matters.
Yes, his calculations suggest a significant fraction of people, even those in the bottom half of the income distribution, receive inheritances or gifts over their lifetime that are equivalent to many years of their own labor income. It's a substantial factor across the board, not just for the super rich.
You mentioned Piketty quoting Durkheim, calling the rentier, the person living off inherited wealth, an enemy of democracy. Why is extreme inherited inequality seen as a threat?
Because democratic societies are often built on an ideal, even if imperfectly realized, of meritocracy, that success should reflect effort and talent, not just birth. When inherited wealth becomes overwhelmingly dominant, it challenges that ideal, potentially undermining social cohesion and the perceived fairness of the system.
Are inheritance flows similar everywhere?
No, there are differences. Piketty notes, for instance, that Germany saw a stronger rebound in inheritance flows than France after the mid-20th century dip, partly due to different historical capital levels, but also maybe recent patterns of gift-giving. Demographics also play a big role.
Okay, another key factor: unequal returns on capital. Why is this so important for the future?
Because if people with more capital consistently get higher rates of return on that capital, it acts as an additional powerful force concentrating wealth at the top, compounding the RG effect.
Piketty was critical of Forbes-style rich lists.
Yeah, he finds them problematic for rigorous analysis.
Yeah.
Their methods can be a bit arbitrary based on who's famous, using rough estimates, sometimes counting families, sometimes individuals. It makes reliable comparisons over time or between countries very difficult.
So he looked at university endowments instead. What did he find there?
Yes, U.S. university endowments provide more transparent data. She found a clear pattern. The bigger the endowment, like Harvard's or Yale's, the higher the average annual rate of return they achieved historically compared to smaller university endowments.
Why would bigger endowments get better returns?
Likely a combination of things. Better access to sophisticated investments like private equity and hedge funds, ability to negotiate lower fees, perhaps hiring more skilled investment managers, and just economies of scale in managing large pools of capital.
But he warned against applying this directly to individuals.
Right. Individuals usually face higher fees, might not have access to the same deals, and there's always the risk of messing up or spending the money. He suspects individual wealth distribution tends towards more stability than just indefinite divergence based on returns alone.
What about sovereign wealth funds, like from oil countries?
Data there is much less public, generally, making it hard to assess their strategies and returns systematically. Norway's fund is an exception, quite transparent. It initially had a more conservative strategy than top endowments, possibly lower returns on average, but also very low management costs. Different models exist.
We've seen the social state grow massively in the 20th century. How is that measured?
Primarily by looking at total tax revenue as a percentage of national income. It went from under 10% in most rich countries before 1910 to anywhere between 30% and 55% today. That reflects the huge expansion of government spending on pensions, healthcare, education, infrastructure, etc.
And while people might agree on abstract justice, they disagree on the details.
Absolutely. How much redistribution is right? What rights should be guaranteed? How do you balance luck and effort? These are fundamentally political questions that different societies answer differently through democratic debate. There's no purely economic answer.
Education levels have risen, but income inequality hasn't necessarily fallen. Why not?
It might be an educational arms race. As average qualifications rise, you need even higher qualifications just to maintain your relative position. Piketty also notes research suggesting social mobility hasn't clearly improved and might have even decreased recently in some places like the U.S. Education alone isn't a magic bullet for inequality.
Pensions are a huge issue. Pay-as-you-go versus capitalized systems.
PA-go systems, today's workers pay for today's retirees, are strained by aging populations. Capitalized systems, saving and investing contributions, are often proposed as an alternative, potentially benefiting from higher returns on capital, RG.
But there's a catch.
The huge catch is the transition. How do you pay benefits for current retirees if current workers' contributions are now going into investment funds instead? It's a major political and fiscal hurdle.
Progressive taxes, even if the overall system isn't super progressive, still matter at the top.
Yes, taxing the very highest incomes and largest fortunes at higher rates can significantly curb the concentration of wealth, even if taxes are flatter elsewhere. Piketty argues the decline in top-end progressivity since the 80s has contributed to rising inequality.
The US and UK used to be quite tough on high incomes, especially from capital.
Surprisingly so, yes. In the mid-20th century, they had very high top marginal income tax rates and estate taxes, particularly targeting unearned income from capital. It reflected a stronger societal skepticism back then about extreme wealth, especially inherited wealth.
And what about CEO pay again, linked to lower taxes?
Piketty presents research suggesting the surge in executive pay correlates strongly with falling top marginal tax rates. The argument is that when taxes are lower, executives have more incentive to bargain aggressively for higher pre-tax pay, and boards have less incentive to resist. It's seen more as a function of bargaining power enabled by tax changes than a reflection of increased productivity.
Which leads to his most controversial proposal,
Okay.
a global tax on capital.
Yes, a progressive annual tax on individual net worth. He sees it as a utopian idea, perhaps, but potentially a way to regulate global capital flows, increase transparency, reduce inequality, and provide revenue.
But the challenges are enormous.
Immense. It would require unprecedented international cooperation on defining the base, setting rates, valuing assets consistently, and sharing information automatically to prevent evasion. Truly global implementation seems very distant.
So maybe regional first, and what's needed practically?
He suggests Europe could potentially pioneer it. Practically, it needs automatic exchange of bank information globally, which is starting to happen, and reliable ways to value assets annually. It needs to avoid the pitfalls of older wealth taxes that failed due to exemptions, poor valuation, and capital flight.
He comes back to public debt at the end. What's the main takeaway?
That public debt is fundamentally a distributional issue. Who owes what to whom between the public and private sectors and between different generations. He highlights the paradox of Europe having vast private wealth but struggling to manage its public debt.
And that economic golden rule where R.
That's a theoretical concept where capital accumulation is maximized for consumption. Piketty argues we're nowhere near it, that R has always been significantly G historically and likely will remain so.
Yeah.
Achieving RG would require far more capital than we currently have.
Not the same as the Maastricht golden rule for deficits.
No, completely different.
Yeah.
The Maastricht rule was about government borrowing only for investment, not current spending, more of a political construct for monetary union than a deep economic principle.
Okay, so wrapping this all up for our listeners. We've journeyed through Piketty's analysis, historical trends, the power of RG, the role of shocks and policy, and these potential future tools or challenges.
It's a complex picture, but these interconnected ideas give you a powerful framework, I think, for making sense of the economic forces shaping wealth, inequality, and opportunity today. Understanding these long-term dynamics is crucial.
Absolutely. So the final thought we want to leave you with is this. Having heard this deep dive, what are the one or two key things that really stand out for you? Is there a new way you'll look at wealth, inheritance, or inequality in your own life or the world around you? Something to reflect on.